Hello and welcome to Cyan Investment. This analysis is for copper as of 10th of July 2026 with a spot price of $5.94 a pound. The full report is on cyan.ca. The right structural metal on a genuine deficit but downgraded from strong buy. US futures flipped into contango, so the ETF now bleeds roll yield. The tariff inflated price can snap back and a pro-cyclical metal faces a growth headwind. Hold short. Own the long case in physical, not CPER. On the fundamentals, copper is genuinely tight, the cleanest of the three. The annual charge to process concentrate settled at zero, a record low, and spot charges have gone negative, meaning smelters are paying miners for ore. Two big mines are impaired. Grasberg is under force majeure, down about 300,000 tons, and Cobre Panama is still offline. Refined supply is growing under 1%. Against that, China's grid build and AI data centers have taken over as the demand engine. The result is a real deficit. Valuation is judged on the global price, and their copper is fair. The London 3-month price, about $5.94 a pound, sits right at the low end of the $5.50 to $6 band. New mines need to break ground, high enough to keep existing mines running, not yet high enough to unlock the new supply the deficit demands. That gap is the structural bull. It's comfortably above the 90th percentile cost floor. The catch is the American price, around $6.28, which carries a tariff premium that can unwind. Here's the catch that drove the downgrade. American copper futures have flipped into contango. Each further out contract costs more, because the market is pricing a proposed tariff into forward months. The popular copper ETF holds those futures, so it now bleeds roll yield. You lose money rolling the position, even if the metal goes nowhere. Speculative longs are elevated after the rally, and the price is a few percent off its high. The metal's trend is fine, the vehicle is the problem, which is why you own physical. The risks are as much about the vehicle and the tariff as the metal. If the president rejects or delays the refined tariff, the American premium collapses and the warehouse overhang floods back. The 2025 precedent was a 20% drop in under a month. A pro-cyclical metal into a higher-for-longer economy, plus any disappointment in China's grid spend, caps the demand side. And even if the metal holds, the futures ETF keeps bleeding roll yield in this contango. These are why the short-term call is hold. Now weigh the risk against the reward. The bull case is roughly 18% above today, the base case, the most likely, about 3%, and the bear case, a fall of about 12%. So you are risking about 12 to make 18. So, our call on copper, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Cyan Investment at cyan.ca. The link to the full report is in the notes below. Have a great day.